A sudden spike in oil prices and a massive sell-off in U.S. equities has sent shockwaves through the financial markets. President Trump declared the Iran ceasefire agreement over, escalating geopolitical tensions and reigniting inflation fears. Here's what you need to know. In the wake of today's events, investors will be closely monitoring the upcoming Federal Reserve minutes, set to release tomorrow, to assess whether policymakers discussed potential rate hikes in light of the recent inflation shock. This comes after a series of economic indicators have pointed to rising prices, particularly in essential sectors. New Fed Chair Kevin Warsh has indicated a disfavor for forward guidance, which has traditionally been used to signal future monetary policy. However, the pressures from rising oil prices may force the central bank to reconsider its stance. Oil prices, which have surged due to geopolitical tensions and supply chain disruptions, could drive inflation even higher, complicating the Fed's decision-making process. If oil prices remain elevated, the inflation wake-up call could persist, leading to further sell-offs in tech stocks and ongoing pressure on major indexes like the S&P 500 and NASDAQ. The technology sector, often sensitive to interest rate changes, could face significant valuation adjustments as investors reassess growth prospects. Additionally, the market will be watching for any further U.S. military actions or shifts in diplomatic strategy regarding Iran. Any escalation in this region could prolong the current volatility and exacerbate supply chain issues, particularly in energy markets. This situation prompts a critical question. How will the Federal Reserve respond to the renewed inflation threat? And what strategies will investors adopt in a market increasingly influenced by geopolitical risks? The potential for rate hikes could reshape investment strategies, leading to a flight to safety in bonds or commodities as investors seek to mitigate risk. As we approach the Fed's meeting, market participants will be keenly focused on the implications of these decisions, setting the stage for a tumultuous period ahead. Investors must prepare for a landscape where both economic indicators and geopolitical developments play pivotal roles in shaping market dynamics. The recent market optimism had been largely fueled by strong corporate earnings, especially within the technology sector. Companies like C3.ai reported impressive earnings beats, with their innovative AI solutions gaining traction in various industries. Meanwhile, Samsung enjoyed a remarkable 19-fold increase in Q2 operating profit, driven by robust demand for semiconductors and consumer electronics. This positive sentiment led to significant gains, pushing the Dow above 53,000 for the first time in history. However, this confidence was precarious, stemming from a crowded bet on a stronger U.S. dollar and historically high valuations in tech stocks, which had raised concerns among analysts about potential market corrections. The fragile truce with Iran had provided a sense of geopolitical stability, contributing to a favorable market environment. However, the collapse of the Iran deal, following renewed military actions in the region, shattered this narrative. This development exposed the market's sensitivity to energy prices and inflation expectations, acting as the catalyst for today's sharp sell-off. Investors quickly reassessed their positions, realizing how external factors, such as geopolitical tensions, can dramatically impact investor sentiment and market performance. The stark reversal we witness today illustrates the delicate balance in global markets, where optimism can swiftly turn to uncertainty. As energy prices surge, inflation concerns are reignited, prompting fears of tighter monetary policy from the Federal Reserve. Looking ahead, analysts suggest that investors should brace for increased volatility as markets adjust to these new realities. Corporate earnings will remain in focus, but the interplay of geopolitical dynamics and economic indicators will play a crucial role in shaping future market trends. The road ahead may be bumpy, but strategic investments in resilient sectors could provide opportunities for growth amid uncertainty. The recent surge in oil prices, driven by escalating tensions in the Middle East, has sent shockwaves through global financial markets. This spike serves as a critical wake-up call for investors, signaling renewed concerns over inflation. The implications of this situation are profound, as they threaten the Federal Reserve's ability to cut interest rates or maintain a soft monetary policy in the near future. Historically, Rising oil prices have been closely linked to inflationary pressures, which can force central banks to act more conservatively. As a result, there are heightened expectations that the Fed may need to keep its policy tight to control inflation, potentially delaying any anticipated rate cuts that had been hoped for in the coming months. The immediate impact of this situation has prompted a significant sector rotation within the markets. Investors are increasingly fleeing from volatile tech and semiconductor stocks, which had previously enjoyed bullish sentiment. Companies like Samsung and Nvidia, once seen as stalwarts of growth, are now experiencing sharp declines in their stock prices. This sudden shift from market optimism to a sell-off underscores the vulnerability of growth stocks to geopolitical events, revealing how quickly sentiment can change in response to external pressures. For the average consumer, the ramifications of rising oil prices are tangible and concerning. Increased oil costs can lead to higher gas prices, which in turn can raise the cost of goods and services across various sectors. As businesses face increased operational expenses, they may pass these costs on to consumers, further exacerbating inflationary trends. The broader economic stability is at risk, as inflation once again becomes a primary concern for both policymakers and the public. Looking ahead, analysts are closely monitoring the situation in the Middle East and its potential ripple effects on global oil supply and prices. The Fed's next moves will be critical as they navigate the delicate balance between fostering economic growth and controlling inflation. Investors and consumers alike should prepare for a period of heightened volatility, as geopolitical tensions continue to shape economic landscapes. The coming weeks will be pivotal in determining whether the current trends will stabilize or escalate further, impacting financial strategies and consumer behavior. On July 9, 2026, U.S. President Donald Trump announced that the Memorandum of Understanding aimed at ending the war with Iran was officially over. This declaration followed a night of intensified military actions, including U.S. strikes on Iranian targets, marking a significant escalation in a long-standing conflict that has roots dating back to the 1979 Iranian Revolution. The announcement, made at approximately 9 a.m. EDT, sent shockwaves through global markets as oil prices surged nearly 3%, reflecting renewed fears of conflict in a region that is vital to global energy supplies. Historically, tensions between the U.S. and Iran have led to significant disruptions in oil production, and this latest escalation raised concerns about potential supply shortages. The Strait of Hormuz, a critical choke point for oil transport, remains a focal point of concern, as any disruptions could have far-reaching implications for global energy security. In direct response to the geopolitical turmoil, U.S. stock index futures plummeted, with Nasdaq futures hitting a 4-week low. The Dow Jones Industrial Average experienced a significant drop of over 570 points by midday. Investors, facing uncertainty, quickly abandoned riskier assets, particularly technology stocks, which are often sensitive to market volatility. The swift market reaction highlighted the fragility of investor confidence, which had been buoyed by recent strong earnings reports and economic indicators suggesting a stable recovery. This marked a stark contrast to previous market trends, where optimism had reigned supreme. The sudden shift in sentiment underscored how quickly geopolitical shocks can alter the financial landscape, illustrating the interconnectedness of global events and economic performance. Analysts noted that rising yields compounded losses for equities, particularly in sectors heavily reliant on borrowing. The implications of this situation extend beyond immediate market reactions. Heightened tensions could lead to an extended period of instability in the Middle East, potentially disrupting essential trade routes and affecting international relations. The broader economic impact may manifest through increased oil prices, which could contribute to inflationary pressures in the U.S. and abroad. Looking ahead, the focus will likely shift to how the U.S. government and its allies respond to this escalation, as the potential for renewed diplomatic negotiations or further military action remains uncertain. Investors will be closely monitoring developments that could reshape the geopolitical landscape in the months to come. As we consider the impact of today's events, how will the Federal Reserve navigate this renewed inflation threat? Share your predictions in the comments, and don't forget to subscribe for daily deep dives into the latest news.